In this video, I'm going to discuss 6 different stocks that are buys in April based on the truth without the hype. I'm going to present my research to you and why I believe these 6 stocks are going to outperform the market. Uncle Henry is about to make you stupid rich, so let's get into it. By the way, one of the stocks, which is my favorite of the bunch, I'm creating a model on that I'll send out through email, so make sure you sign up for free emails for that report in the description. Let's make some money. Stock number 1 is Applied Material, ticker symbol AMAT. Applied Material was founded 55 years ago with operations across the globe in the US, Asia, and Europe. It's a leader in materials engineering with solutions that are used to produce virtually every new chip and advanced display in the world. I'm playing this stock based on the semiconductor chip shortage. It's generally a good idea to buy above average companies at below average prices. The company's expertise includes modifying materials at atomic levels and on an industry scale, and its manufacturing equipment, services, and software serve the semiconductor, display, and related industries. It has an installed base of more than 43,000 tools with field service engineers and leading chip manufacturers worldwide. It's set to benefit from the current strong tailwinds in the semiconductor industry, driven by data center buildouts, 5G deployment, gaming, and autonomous driving, as well as the accelerating adoption of electric vehicles, which will need increasingly complex semiconductor chips. Applied Material was a stock that an industry veteran at a hedge fund that I used to work at followed closely and told me to buy at $20 per share in 2015. I missed a 7x stock, but looking at the current AMAT price, this stock can still have fantastic results going forward again. The second stock is Adobe. ADBE is a ticker symbol. Adobe is off nearly 40% since its high. I see the stock as bottoming and ready to move higher because the fundamentals look good and the valuation is outstanding. Software stocks have been absolutely hideous, downright awful so far this year. The group is highly correlated to investors' collective willingness to pay high multiples for high growth stocks. And of course, that willingness went down by a lot essentially immediately in early 2022. As we get into quarter 2 of 2022, in April, I see a big turnaround in software stocks. Adobe shares plummeted in more or less a straight line from $700 to about $415. This behavior looks like it's bottoming out, and if we look at the momentum indicators, we see more evidence that we may be near or at the bottom for Adobe. Fundamentally, I also see one key important change in their business, which is important to mention. As a software stock, Adobe has outstanding margins. That doesn't market outside from the others in the group, but I think there's a very strong margin growth story. You can visually see how stable revenue growth has been and margins have exploded. I like the look of the bottoming action we're seeing in Adobe, but I also very much think this company will remain a leader for years to come. So it's a good buy in April and beyond. Stock number 3, the next stock is NIO. I don't need to make an intro, so let's discuss the outlook for NIO stock. NIO projects to produce and deliver a total of 25,000 to 26,000 electric vehicles in the first quarter, showing an increase of approximately 25 to 30% compared to the year earlier period. The guidance for Q1 2022 implies deliveries of at least 9,200 electric vehicles in March, which would indicate at least a 50% delivery rebound month over month. As deliveries start to exceed 10,000 units per month again, NIO could achieve up to 190,000 electric vehicle deliveries in fiscal year 2022 as new models launch. In April, if and when numbers come out for deliveries are positive, there could be a huge swing in NIO stock and change of momentum. From a revenue and delivery growth perspective, NIO has become too cheap, I believe, and the stock continues to represent deep value at the current price to sales ratio of just 2. Compared to competitors, it's in line, so it's likely the entire industry is undervalued. The risk reward looks extremely attractive here for NIO, in my opinion, and I think the stock can head up much higher in 2022, and that could all begin in the month of April. April. Stock number 4 is Alibaba. Alibaba is another Chinese stock. I mentioned that I made a big investment at $100 per share by selling a lot of put options, basically obligating myself to buy the stock at $100. And I got so many comments, some of the same comments that made Chicken Genius Singapore, if you know who that is, who quit YouTube. I was getting similar comments from people basically calling me a bad investor and stupid because I believed that Alibaba was a good buy at $100. Its short-term fell much lower, and understandably, people thought the stock was broken, and I don't know what I'm talking about. I'm not perfect, but when I see deep value, I recommend it to you guys. Currently, more than 33% of Alibaba's market cap is in current assets, and almost 55% is in current assets, net properties, plants, equipment, and equity investments. It can basically become a pure asset purchase at today's valuation in just a few years if they keep building up cash. If they keep running their business and hoarding cash, then they will have as much cash and assets as their market cap in a few years, which is completely mind-boggling because this company is really cheap. That's how undervalued the stock currently is. We have already seen a big swing from around the mid-70s up to over $110 per share. I believe positive momentum is going to continue in April. Stock number 5 is marketplace company Fiverr. They operate a platform where people sell freelancing services for a wide range of skills. This might be graphic design, copywriting, or virtually anything else online that helps online businesses and services. The stock became very popular during lockdowns when remote work and freelancing became a lot more mainstream. Much of Fiverr's fall is due to a valuation correction and weakened sentiment towards growth stocks, not due to fundamentals. The stock has been down more than 30% since the beginning of the year and a whopping 70% over the past 12 months. Management is guiding for 25 to 27% revenue growth in 2022. So Fiverr is still growing at a healthy pace. Its free cash flow turned positive during the pandemic and was $35 million in 2021. I expect this to increase as revenue grows. Profitability margins are also expanding thanks to economies of scale inherent in a business generating right around 80% gross margins, which is as high as I've ever seen for any company on the stock market. This is a platform company like Uber and Airbnb, and because they can keep their costs so low and their margins so high, this is one of the most attractive businesses out there. Not to mention, the gig economy is growing. I have hired from Fiverr myself, and business is still growing on all fronts on Fiverr's end. Check this out. Active buyers is consistently growing, currently at 23% year over year. Spend per buyer is also growing 18% year over year. These two metrics are a slam dunk because one is saying the number of people on the platform making purchases is growing, and then the other is saying each one of these customers is paying more money. That's double expansion. I believe in April, you can capitalize on the current big disconnect in this stock. The next stock is Hims. Hims & Hers is a telehealth company focused on digitalizing and simplifying the traditional healthcare experience. Patients can quickly and easily access a network of doctors online and pick out a treatment plan from the comfort of their home. The treatment is then shipped directly to the patient within a few days. The company primarily targets millennials with stigmatized healthcare conditions such as hair loss, mental health, and various other age-related issues. The company went public as a SPAC via Oak Tree Capital Management in 2021. At the time of that deal, Hims was valued at $1.6 billion. The current market capitalization of the company is exactly $1 billion. Investors and investment bankers valued the company 60% higher than it's trading at today. I did a lot of digging into this company and have expertise in the drugs that they offer because I've taken biology classes in college. Hims has two distinct competitive advantages over other telehealth companies, which makes me very bullish. Number one, it is the lowest cost provider of telehealth treatment. Number two, it has the best brand recognition. Hims' gross margin regularly sits in the mid 70s. And as you know, the mid 80s was the best margin that I've seen on the stock market for Fiverr. So Hims also has a very high gross margin, which allows them to safely spend more dollars on marketing, thus increasing the company's brand awareness. This is basically a network effect because the more customers are ordering from Hims, the more money they get, and with that money, they keep spending it on marketing, driving more customer acquisition. Being the lowest cost provider in an exploding industry is a huge competitive advantage, especially if combined with excellent marketing. The company's revenue has grown at a compounded annual growth rate of 117% over the last 4 years, and many other areas have steadily improved, such as subscriptions, retail expansion, and liquidity ratios. Furthermore, the company has zero debt, $250 million in cash, and 196 million shares outstanding. Thus, the cash per share works out to be about $1.27. Since the stock currently trades just over $5, that's a huge percentage of their market cap, making this a very safe investment, or at least very safe for a small and fast-growing small cap company. Hims had a very rough time in the market in the past year as the stock price has dropped from the high of $25.40. We're currently getting about 1/5 of the peak price if you're buying Hims today. Hims is also another stock that has recently gotten sold off because it falls into the growth stock bucket. I expect this to shift come April. I can see the stock moving up to $8 per share, which is a 60% increase sometime in the next 6 to 12 months. The last stock I'm going to send out over email and Discord, so make sure that you use the first 2 links to get on the free email list if you haven't already submitted before, or the Discord for mentorship, option trading signals, and a kick-ass community of option traders getting amazing results. Thanks for watching.